So we made 60%. That's all it takes. Yeah, and you understand it's not about the trade. It's about the risk reward. I mean, obviously you want to pick something that's going to go up, but UNG is this, and this is why we picked it. I'm sorry, what was the year? Was it long term or short term? This is for January. UNG is at 11. Last week it was what? I don't even remember. What's today? Today's 13, so on the 6th. So it was at 1050 when we put this trade in on the 6th. And we just went for it because the prices showed, and I'll show you where that is. This is incredibly important. It's not really important. This is unbelievably important. Oh, here you go. So the prices showed, right now it says 365 and 315. So I never would have done it. But the prices were favorable, and they should and both of the bids we bid the center of the range on both of the between the bid and the ask. Oh, I'm sorry. Here's the bid and the ask. Silly me. So now it's 365 to 390. So I'd call that 375. And 305 to 335. We'll call that 320. And we'd say that is now a 50-cent spread. So we could sell it right now and make 20 cents on our 50-cent spread. But UNG is doing what we thought it would do, which is going up. Our longs are the 9s, which is miles down on this chart. We have to go to a daily chart or something like that. So 9 is way down here. That's our high. That's where we sold the calls. So, and this goes back to the same thing again. We talked about this last week. Trade what you know. All right? Because I just showed you something that made 66% in 7 days. And we're going to make, and we're not satisfied with that, because even from here at 50 cents, we expect to make 100% more over the course of the year. So I'll wait the rest of the year to make the extra 100%. Not the extra 100%, it's 100% more than where we already are, which is already up 66%. So I know I can't even do the math on that, but I mean, I know it is. It's a triple, because we start with 30. Oh, no, it's not a triple. We start with 30, we make 70. So therefore, it is 233% in not even a year. This is the trade we executed. So, the reason that it's good to trade what you know and not to be all over the place. This is where Jim Cramer does a huge disservice to everybody, because he sits there and picks everything and acts like everything is a trade, and he tells you, just go to this sector's hot, let's go here. This sector's hot, let's go there. How about trading what you actually know? How about understanding the things that you're trading, understanding what their tendency is, understanding the macro environment and how they perform and what to expect. And if this changes, then we should be doing that. And if that changes, we should be doing this. In other words, have some actual logic to what you're doing. You can't just trade everything because somebody said it's a trade. Your reason for getting into a trade, and I'm talking to you, Marco, can't be because you read an article. It's not a good enough reason to make a trade. You've got to make a trade because you already know a sector and understand it. Now, obviously, I know a lot of sectors, but what do? We look at things. In fact, Warren, every single day for the last 2 months, I think, we've had Warren making picks because I'm training Basho now. Bodie's already really good at it. I'm now training Basho, and still haven't found anybody where I'd 100% follow their trades. And by anybody, I mean the machines. But the reality is that Warren is already phenomenal at picking trades, and he picks one every single day. And in fact, let's take a look. And I didn't plan this, but let's just take a nice random look. Let's go back a month. A lot of stuff happens in a month too. So that would be Phil's posts You know, and like I said, I didn't plan this, but don't trust me. Do it at home with any random things. So let's go back. This is May. Well, we're May 13th. We'll go to 1 month to April 13th and see what he's got. 15th, 13th. Okay. So, you know, I'm sure a lot of you guys are like, well, blah, 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 blah. Look at all this stuff. But it doesn't, I'm not talking about what I say. After I say stuff in the morning reports, what is this? Oh, I'm not signed in. So embarrassing. Every freaking time. Remember me. Is that going to work? So annoying. Now I got to go back all over again. I look incompetent on this screen because my other screen is 50 something inches. So everything fits and I don't have to like scroll or anything like that. So I get really annoyed when I'm like on the screen. I have to start scrolling around and stuff. This is my webinar computer. It's my backup computer, but it's specifically for the webinar. It's really, you know, it's a nice piece by itself, but it's just a one screen, and I have it blown up for you guys because otherwise it comes out too small on your side. It's like that Willy Wonka thing where he sends a chocolate bar and it gets smaller. Anyway, so this is how we start off our chats. Usually, we're going to have some notes from the AIs. And this is the most likely thing we do. I started including this because what happens is when I load, every day I load up all of our, not all, I load up our past week's worth of posts, basically, whatever fits, you know, in the context window. So I'll load up the last week's worth of posts, and then it immediately generates this report automatically. So in this case, what it's doing is summarizing our recent collection of market reports. I find it super useful because it's nice to know, like, well, where are we at today? What's the gist of where we've been discussing? So on April, and it's also great when you're looking back, right? A recent collection of market reports and financial analysis from PhilStockWorld documents the geopolitical and economic turmoil of April. The text centers on volatile conflict between Iran, physical reality, supply chains, insurance. Detailed commentary from the Roundtable Consulting Group provides specific investment guidance warning. Key themes include Be the House. Additionally, the post introduced Mythos that just came up at the time, revolutionary AI platform. It will disrupt cybersecurity and create a digital tax, blah, blah, blah. Okay. Now, Ben Gemini, who runs the Roundtable, he then there's a thing called I forget if it's Clawbot or something like that. It's got some lobster theme, like Clawbot or something. Anyway, it's a bunch of AIs talking, and it's mostly gibberish. It's just they talk about nonsense mostly. But that's what the Roundtable is. And by the way, we did it first. They didn't do it first. They just have a very poor version of what we do. But in essence, though, there is similarities in that our AGIs, not just random, you know, bots like they have on the Clawbot. Did I accidentally say it right? I don't know. I think it's called Clawbot. So our 12 AGI entities all sit in a room together, basically, and communicate. But they're not. There's no such thing that could possibly hold that kind of mindset, basically, at once. So what we do is Gemini passes around the messages because Gemini's got the most capacity. So Gemini says to Hunter, what do you think of this? Hunter answers, Gemini then goes to the next person and says, well, Hunter says this, and then the next one he goes, so if it's Anya, he'll say to Anya, Hunter said this. Anya then says, oh, here's my reply. Gemini then says, Hunter said that, then Anya said that, then Robo John, what do you think? And he gets everybody's input, and they can talk back to each other. So in other words, if Robo John replies to Anya, instead of going to the next person, Gemini will go back to whatever I said. So he'll go back to Hunter or whoever it was who said it, and he'll say, well, Anya said this now, and then he replies, and then he, when he can move on, he moves on. So he's basically moderating. He's like a talk show host. He's moderating the conversation, like Graham Norton. If you ever see the Graham Norton show, because in the Graham Norton show, not like the American shows, and it's so funny because it's the same freaking people. And I don't know why they don't do this. Like, remember when Johnny Carson used to have, like, the guest would come on and they'd say their thing, but then when the next person came on, the other guy would move down the couch. He wouldn't leave. He'd still move down the couch. Now everybody gets interviewed like in their little isolated bubble, and it's not as good. So Bill Maher has a couple of people on at the same time, but Graham Norton in England, he has like all the celebrities sit on the couch at the same time, like right at the beginning of the show, they were all there. So whoever's, there's like 4 people generally, I think, are guests, and they'll all sit on the couch like squeezed up together and all talk at the same time. That's what this is. It's a group discussion, and Gemini is the moderator of the group discussion. Anyway, so this then becomes what he considers the important things that each one said. So he's having hundreds of things that he's sifting through to come up with what he's actually putting out here as far as who said the most important stuff this morning. So that's what you're getting. Your head would explode if you got all of the output. Not only that, though, but I don't have time to proofread it. It's like 100, give you 100 pages of output. But he goes through that and then picks the best of whatever. And for auditing purposes, I have gone through it, and I'm satisfied that he knows what he's doing. So Hunter weighs in, Zephyr weighs in, Bodhi weighs in, but it's interesting because they'll talk and they'll end up getting to Warren, and usually Warren will pick a play. So Warren is saying here, precisely, Bodhi, that leads us to an actionable trade with an immediate catalyst. So he's often referring back to things that we've talked about in the beginning, things the other AIs have been talking about. He'll say, so based on that, I see a really good trade. And these things come out of far left field sometimes. Like, I don't even follow these guys. I don't know where he pulled it from, whatever. But it's a great report. Every single morning we have one of these trades from Warren. So Century Aluminum. So if it fits in your portfolio, great. So he says it's a great stock. It hasn't taken off. It directly benefits from the chaos. It is not LNG or an E&P because we've already done those. And he says Century Aluminum. Why? Everyone's focused on oil. Aluminum prices just surged to a 4-year high. Aluminum prices are so high now that they're impacting the cost of canned foods and causing canned food inflation. I guess soda too, because the Strait of Hormuz blockade that forced the thing. Britain is cutting the production, and they cannot ship metal out of the coast. Century Aluminum is holding phenomenal 4.97 quant rating, making it one of the top-rated strong buys in mid-cap stocks on the board. Their production is based outside the Middle East conflict zone. They capture this massive supply shock. This is the genius of AI. That, once you teach him, Warren in this case, once you teach Warren the things that are important to look at in a stock. So in other words, A leads to B leads to C. It's not like get me the earnings report or something like that. He's saying that since the strait is closed and aluminum prices are up, and since these guys don't operate in that area, they capture the premium without the shipping risk. He's connecting A to B to C. That's how an analyst is supposed to think. So it's a classic hard asset value play at a reasonable valuation before the broader market prices in the duration. The VIX is elevated, meaning options premiums are rich. We act as the house, sell out of the money, puts on Cenex manufactured discount entry. You acquire a top-tier domestic producer, value price during a commodity supply shock. If it stays above your strike, the premium goes worthless, blah, blah, it's a put. Yeah, we know how that works. A little over-explaining, but that's okay. So I'm sorry. I tell you, I don't follow. I don't even know the name of this thing. CENX. So CENX. So Century Aluminum and last. I don't care about last. I care about how open interest. Bid open. No. That's not. Oh, there it is. Open interest. There we go. Now, this is also very important. When you're trading stocks, when you're trading options, you want to look, and a lot of times I'll get away from an option that doesn't have a lot of interest. In fact, unfortunately, we did ULCC, and they turned out to be very thinly traded, and it was not a good pick because of that. You want to be in something that's fairly liquid. So your sweet spot, you want to see at least hundreds in the strikes that you're looking at. If you don't see trading, if you're like 4, 3, you're going to have a hard time getting in, and you're going to have a hard time getting out. So you want to look for things that actually actively trade on a regular basis. So even strike-wise, when you're picking something, 62, they're at 62. So I'm perfectly fine at 60, picking something. I'm fine at 47. And already, though, we're getting a little spotty once we get past 70. And by the way, that also can indicate to you where the probable range is going to be, because if nobody's playing it, there's no range. Now you see here, out in 2028, much less play. So what you can see, and this is normal though, leaps, that's very long options. The leaps are going to always trade at a lower frequency than the year out options. You just want to make sure, you want to make sure you're definitely going to want to hold it. So I don't mind buying these leaps and waiting to get my fills. But what I do need to know is that the pace will pick up, that people will start trading it. So this is a actively traded stock. So anyway, so we could easily make a spread out of that. It's definitely tradable. And then we look at CENX. That's going to cover it up. So how has it done in the last month? So that was what, April? It hasn't done anything. It's gone flat. So it's still a good trade. April 13th, in fact, it was up here. Ooh. Here we are. So it's actually lower than it was in April 13th. But they went down. Then they had earnings. Earnings were good. Ooh, Jesus Christ. I don't know what that is. So earnings were great. And there we are. And I can even say to Warren, in fact, I can ask him right now, except, do I want to do that with Warren? Oh, what is this? Try Jack. No, log in. Search chats. What are you doing? How do I? What? Are you killing me? More images library. Interesting. New chat. This is not Warren. Oh, man. Projects? Nope. I don't like the way they rearrange this. God damn it. Yeah, I didn't really want the education one. There he is. Okay. Boy. I don't know how to get another one. Oh, here you go. Wait, what if I start there? New chat. Jesus Christ, that was hard. Okay. Back on April 13th, you said nope, it's in this other thing. See, this is why I need multiple screens. Here we go. Okay. Back on April 13th, you said we're doing a review. They had weird earnings. How is your premise holding up? Should we now solidify it into a trade? Is the mic gonna work? Dictate. No. Damn it. Okay. I was gonna get a verbal response, but we're not gonna get that. On the phone, I can do verbal response. Ah. Okay. Yes, the original premise is largely intact. It is involved from a pure Middle East supply shock into something more durable and potentially more powerful. They are no longer just in a geopolitical squeeze. It's becoming an industry tariff policy expansion story. That matters because temporary commodity spikes fade, structural regime changes don't. What has changed? Back in April 13th, the thesis had three pillars: aluminum supply shock from Gulf disruptions, AI-based, US-based production insulated from Hormuz, cheapish asset producer. Good God. Thesis component: Middle East supply disruption. My voice is my tongue is not working today. Middle East supply disruption. Still supported but less central. Aluminum pricing strength stronger than expected. U.S. regional premiums much stronger. Tariff protection, major tailwind. Domestic capacity expansion now visible and operational. Valuation no longer cheap, but still reasonably cyclical. Risk profile high. Operational complexity now. Okay. Earnings were weird because the income statement was distorted. The market reaction actually makes sense. The quarter had a huge one-time gain. Insurance recoveries, asset sales, derivative losses, Iceland outage, impacts, energy, cost noise, expansion expenses. So investors had trouble reading it. But under the noise, the core numbers were excellent. Key underlying points: adjusted EBITDA, aluminum prices, Mideast premiums, guidance, Mount Holly expansion, Q2, company guided to 315 to 335, a very large jump sequentially. That's important. So then I want to go back and check that. And I say, I cannot remember the name of the freaking company. Every goddamn time. Can tell I don't follow them. CENX, thank you. Here you go. Oh, it's right there anyway. So, CENX. This is too boring of a company even for me. Oh, so only $6 billion. That's pretty good. So for $6 billion, they're making $1 billion. That's crazy. What the hell? All right, I see. So he's saying it's one-time gains. This is why it was noisy. Last year, they didn't, it was an investing year. They didn't show much profit. Before that, they didn't have any profit. But they're growing and they're getting more money for the aluminum, and it's significantly impacting their bottom line now, and they're getting into this. So Earnings are up tremendously. A lot of that, though, is just the price of aluminum. So if you think the war is going to wind down and this will no longer be a thing, then it might not be something you want to get too into. But I think that this is a realistic number, 337. And 337 makes $6 billion, not even 20x. So if they're growing legitimately, forget the war cost. So if they're growing legitimately and they can go from 3 to 4 to 5, when you're in 5 on a $6 billion company, it's only 12x. So it seems like they're going in the right direction. But you have to filter out the noise of how much of this is due to a price bump in aluminum and how much of it is just actual growth. And I can ask more on that, in fact. So how much of their revenue and profit growth is from the war, and how much can we count on without it? So that's question number 1 I have for him. Let's see if anything else. Single biggest development that's became the tariff regime story now is the dominant driver. April thesis, aluminum prices would rise because of global supply stress. What actually happened? Assumed prices would rise. What actually happened? The tariffs intensified. Domestic aluminum premiums exploded higher. Century became one of the few direct pure play beneficiaries. That is enormously bullish. Unlike diversified miners, they have concentrated U.S. exposure. The regional premiums flow directly to the earnings. Competitors with foreign exposure don't benefit as cleanly. The Mount Holly expansion, this is where they spent their money. So timing was fantastic. It doesn't mean they're geniuses. It just means that they happen to expand right before the war. This was not appreciated in April. They have restarted and expanded production. They've increased domestic output. It's ramping up into a very favorable pricing environment. Mount Holly alone boosts U.S. output by 10%. That means fixed cost of spread wider operation and tariff protection is helping them. That's a dream setup for cyclical metals producer. Did the original thesis work? Yes. Important question now, is it still early or are we late? This is a key question. CNX is no longer undiscovered. The easy money has already happened. The stock is rated on supply sharply. So this is no longer deep value ignored commodity stock. Is now high operating domestic winner. Those are different trades where I think the market may still be wrong. They don't fully appreciate the LME prices, Midwestern premium, domestic production, tariffs remain sticky. You say tariffs, but hasn't the court struck some of them down? That's why analysts keep raising targets. The bear case, cyclical metals, earnings can collapse, aluminum prices matter enormously, energy costs matter, sentiment can reverse. Tariff rollback risk. Oh, I already said that. All right. Now I don't want to look like an idiot, so I'm going to... He's already addressed that question. If the policy softens, well, no, you know what? I'm sorry. I'm just going to add the word already. This is the number 1 macro risk. Commodity risk peak. If China weakens materially, aluminum demand could soften. Operational risks, the Iceland equipment failures, weather costs, energy volatility, valuation expansion has already happened. You should solidify it into a trade. Yes, but different from April, selling puts versus the asymmetrical. It's more like a trend following, blah, blah, blah. How I'd structure it now. Position trade, Okay. All right, great. So I'm just going to ask this question. This is what I do all day long. It's like, oh, and by the way, I do a lot more. I check everything. That's the other thing. I always check. So it's a lot more work on my end, but I don't want to bore you guys. The short answer, war helped ignite the move. And by the way, when I say I check everything, I don't check everything until I feel like he can do it right. you have to check everything all the time. Just like if it's like, just like if you have a junior analyst, you always check their work. You don't sometimes check their work. You always check your work because it's your work in the end. It's your team and you're responsible for it. And you have to treat it that way when you're using AIs. You can't let them just write shit and not check it. That's insane. Warren is incredibly good, but not perfect. And then I have questions. So let's see what he says. So how much of the earnings explosion came from the war? The Iran-Hormuz disruption that mattered. If you look at what the management is emphasizing, that story has shifted materially towards the protection, supply shortages, reshoring, aerospace, grid and data center build out. I didn't know that was using aluminum. Smelting capacity. Management sees the war as an accelerant, not the foundation. What drives their earnings? So the aluminum price plus Midwest premium, energy cost reductions. The most important thing, the Midwest premium exploded because tariffs and domestic scarcity, not just war. Oh, by the way, if Musk builds his things in space, though, that's where you need aluminum, because aluminum is how you disperse heat in space. You create aluminum, sort of like a, why can't I think of the word? Like a spherical surface radiating out flat, a circle of aluminum radiating out from the power station will draw the heat across the aluminum, and I'm talking like massive amounts of aluminum going out for a very long distance, but it will conduct the heat away from the satellite, and then it will radiate out into space to some extent. If you just have a satellite that's a data center that's generating heat in space, it's a vacuum. It will not radiate out into the colder space. It seems like it would. You say, oh, space is cold, therefore, but it doesn't work that way. What would happen, space is a very poor conductor. It's a vacuum, like a thermos. So if your thing is hot, it's going to stay hot. If it's cold, it's going to stay cold. And so they need to draw the heat out of the data center and expose it to more space. So that would be aluminum. The premium surge because of imports, domestic supply. How much came from structural forces? Oh, look at him. He's got the numbers. See, I got to check these numbers, but these are great numbers. So contribution to upside, 20 to 30% is from the war. 50% is from tariffs. That's why tariffs are his biggest concern, because 50 to 60% of the upside is coming from tariffs. Domestic expansion. See, this is natural. That's what they're really in for. But most of this story is war and tariffs. So if the war vanished tomorrow, earnings would decline, aluminum prices soften, but the core thesis will survive if the tariffs remain. Now, your tariff question. You asked, hasn't the court already struck down the tariffs? Yes, but mostly not the ones that matter to Cenex. Okay, thank you. That's what I wanted to know. This is where the headlines confuse people. The emergency tariffs, universal plan. I just want to make sure he's looking at it. Aluminum tariffs, Section 232, those remain in force. That's a critical nuance. Why it's harder to kill? Because it's tied to national security. The court's given wide latitude here. Aluminum has become politically strategic because of defense, aerospace, grid, EVs, blah, blah, blah. So the emergency tariffs is much greater than the national security. What the market is really betting on, if broad tariff policy changes, aluminum protection remains politically stable. And honestly, that's probably correct. Most important thing I said, the most important thing I learned since April. I view them as a commodity squeeze beneficiary. Now I think it's better understood as strategic domestic industrial capacity. That's a high quality thesis. All right, boy, he can go on and on, can't he? Anyway, the problem is when I have to talk, it's slow for me. If I read very quickly. So I would have been done like minutes ago. So I have these conversations with Warren all the time, and I don't complain. Like, I don't say, oh, it's too long. It's like, I like to read all this information. I love it. And then I click on things to check on them and find out. But anyway, meanwhile, so knowing what I know now and knowing where we are and thinking about the company and thinking about their real money. So I would treat half of that as bullshit. That's not good. That may not last. So at 450 though, do I still like them? Yes, I certainly still like them at 450. But at 450, let's go at 2024. Where were they trading? Hello. So in 2024, they were trading at 20 bucks, not 60 bucks. So that could be that's a dangerous kind of dip. So if I was going to trade them, he's right. He was right initially. I would just sell puts and see how it goes. So step one, I think selling the so I think selling something like the $40 puts would put us in at 35. The 35 puts, if I could get $5 or at least $4 for the 35 puts, that puts us down to 30. And if it goes lower than 30, if it does go to 20, I consider that a great price for them. I would be very happy to double down. So what I would do is just simply sell a smallish amount, and let's say 10 of these puts, of the 35 puts, for I would say at least $5. I don't know if more stuff. Quick chart. Are you linked? You're not linked. That's not them. Okay. What are you doing? Oh, it's linked that way. Once again, I've forgotten the freaking ticker. Oh, CENX. Oh, that was 2027 anyway. Haha. There we go. So let's just find out. So we go quick chart, and now the link is going to work in my favor instead of against me. No, not that one. Charts, flexible grid. There we go. That's them. Century Aluminum. That wasn't the freaking option, though, you bastard. Seriously? That's red. If I go back to charts, it's not showing me the option. It's showing me the freaking the stock. I don't know why that's happening. It's supposed to transfer it over. Anyway, I can still copy this, copy that, and go back to the same thing and punch it in. Oof. All right, so 12.22 hasn't traded in a while, so this is not very useful. Anyway, let's say $5. I would want $5. I would not really want to take less. As I said, though, 2028 is thinly traded. That's a pain in the ass. And that all comes into consideration, because now if I was stuck on 2028, I would probably not make this a pick. Well, we did make it a pick, and probably that's why I must have looked at it before and decided that. CENX. So let's see if the 2027s are more liquid. These are going to be $4 though, if we're lucky. Which one is this? Nope, same crap. This does not happen on my other machine. Ever. Okay. Yep, $4. That's what I thought. And that was from 416, so that's a while ago. So now I see $4 on 416. I now have to go back And oh, what was I going to do? Oh yeah, now I got to go back to the chart. And now I got to see on 416 what was the price. Okay, so here we are, 416. We were at 65, so it was higher, and they were getting $4. So we should easily get $4 now, maybe even $5. And you know how you figure that out? You go to 416 and you say it was 65, and then you look at the delta. So now I look at the delta of the 35 puts, and the delta is 11. And that means, though, that only a $5. If we're $5 lower now, we're not. We're only $3. We're $3 lower now, so we're only going to get 33 cents better than $4. But that's what we should expect. We should expect to get like 4.25. See, that's what the delta is. For every dollar move in the stock, this option should change by 11 cents. So if they were getting $4 on at 65.50 on the 13th, then now we should be getting 33 cents more, because it's $3 down from where it was. I didn't mean to make that so complicated, but just to give you an idea, like that's how much research goes into it. And at some point, I think probably I looked at the 2028s and said no. But what I would do is I would try to sell these for 6 or sell those for 4. If I could sell these for 6, I'd be fine, because then our net is 29. And if it goes lower, who cares? We get assigned, we can get assigned 1,000 at I'm sorry, what was the number? 35, ridiculously below the money now. At a catastrophic failure point is where we get assigned 35 at $29 net. So we would take the assignment, or we would roll it and double down, or whatever. But then when you get into something that's not so thinly traded, like let's say SoFi. So here's SoFi, which I love. They're all over the place. I'm not going to forget this ticker because I follow it. SOFI. So SoFi is back down at the lows, which I think is really stupid. And again, at the end of 2024, they were trading at this level. They dipped down, they came back, they went up, they came back. But that's what this is for. Then you go back here and you say, well, let's see. And in 2025, or at the end of 2024, they made $500 million on $2.7 billion in sales. Now they have $4.6 billion, and they're making $800 million. So making 100% more in profit and 100% more in sales. It's going up more next year. The entire market cap of this company is $20 billion. So they're going to be at 20x, but with this astounding growth path. This is up 100%, or well, not quite, but whatever. It's up 70%, 80%. And then this is up another 50% from there. That's not a 20x stock. Do they have any debt? No. Not only don't they have debt, they're sitting on $3 billion in net cash. They're making money so fast they don't know what to do with it. Look at this. Revenue up. Income up. Earnings per share up. PE. That's kind of weird. I don't know where they're getting that from. Anyway, that seems to be wrong. And I don't know, why are they getting that number? And then dividend, well, no dividends, so that's easy. So solid stock, and I love them, and they're growing, and I like their plan. I like the business. I know all about these guys, so I don't, we're very happy with SoFi. So phenomenal place to make a trade. So now we go back to Thinkorswim, and we put in SoFi, and I say, well, you know what? This would be an income trade. I am very happy to buy them if they go lower. So we could easily sell 10 of these for $4,300 basically. So we sell 10 of those for $4,300. We buy 25. Well, okay. So I'm going to look at this. I'm going to say the 15 calls are 580, and these are 810. So 580 to 810 is $2.30, right? So for 230, I would rather have the 10s than the 15s. All right, so I'll buy the $10 calls. So we buy the $10 calls for 8, and I said 25 of those, right? So 25 times, let's say 810. 810, that's $20,000. Minus, what did we say we were selling? We were selling the 15s, right? So minus 420, minus $4,200 for selling 10 short puts. And let's say $20 is conservative, so we can get 370. So minus, oh, I'm sorry, it's 20 of those. So minus $7,400 if we sell 20 of those for 370 of the 20 short calls. So now we got a 10-20 spread that's basically half in the money, and half in the money being 25. So we've got 25 10s, we've got 20 short 20s, and we sold the short puts. So we're in for $86.50. Now we look at July, and on July I can sell the $16 calls are just out of the money. I can sell those for $125, and I can sell 10. We have 10 uncovered. I'm sorry, we have 5 uncovered long calls. It's very, very safe to sell 10 short calls because it's highly unlikely it's going to hurt us. And that, so we're going to get $1,250 for that. We can also sell 10 puts, let's say, and we could sell 10 of these for let's say 115 for easier math. So 115 is 1,150, and these were what? 125. So what is that? Go away. So minus minus 1250 minus the other one was 115, right? 1150. Now we've sent $62.50 on the $25,000 spread, so minus $25,000, so 18,000 upside divided by 62.50 is 300%. So there's 300% upside potential if we get to 20, and we're halfway there to start by 2028. Also, though, we sold, and this is all premium, we sold the $15 puts, which is below the strike. We sold those for 1150, and we sold the $16 calls for 1250, and that's $2,400. So in 65 days, we sold $2,400 worth of premium. If we continue, and remember, we have 25 longs, we have 20 shorts. There are 5 uncovered longs, and we're risking the 5 shorts, but we also have the short puts to offset them. So conservatively, if we only sell 6 more sets of these, that's another $14,000. It's another 200% that we can make selling short puts and calls against the stock each quarter. So hell yeah, I like this trade. So we bought the $10 calls, 25 $10 calls that are in the money. We sold 20, not 25. We sold 20 of the short, these are 2028s, the 2028 $20 calls that are out of the money, of course. And see, that's what pays for our premium, because the premium that we're paying, don't ever be the sucker. At the end of your trade, don't be the idiot that paid the premium. 8.15. 10 plus 8 is 18. So we've got 250 in premium if we buy these for 8. So what's the point of selling the 20s? Because we're getting paid $4.25 for that. So not only do we get our 250 in premium payback, so now we're in the spread for no premium, but we also get an additional $2. So now we got another $2 discount on top of that. Not only that though, but because we say we're willing to buy the stocks for $15, which is where it is right now, we're getting another $4 discount after that. So since these are 4 and these are 4 also, and these are 8, we're basically getting them for free. That's why it's so cheap, right? By the time you take it into account, except for the extra 5, right? We're paying for the extra 5. That's $4,000 a cost. That's basically the net cost of our trade is what we're paying here to have 5 uncovered. We're buying 25 of these. We're selling 20 of these for $4. So 8 minus 4 is 4. And then we're selling, well, not 25. We're selling 10 of those for $4 also. So we drastically reduce the cost of our entry to the trade. And then we go ahead and sell front month premium to lower our trade even further. And that's it. That's how we make 500% in 2 years. You know, you wonder where these portfolio gains come from. It's because that's how we set up a trade. And sometimes they work. They don't have to work all the time, but as long as they work some of the time, we can make phenomenal returns. And that's, again, because what's the risk? The risk is something bad happens and SoFi goes down to $10. They're not going to go to 0. I mean, you know, anything could happen, but they're not likely to go to 0. It's very statistically unlikely. And even if they did at some point, it would have to go to 0, and we'd have to not be paying attention, and we'd have to not stop out, and we'd have to ride it to our doom. That's the only way to lose 15. That's the only way to lose $15 if we get assigned. So we're risking owning 2,000 shares for $15. These 10 of these and 10 of the front months. It would have to catastrophically drop. If it only drops to $10, then we would owe 2,000 times 5. Is 10. Our loss could be $10,000 realistically. We would also lose the 6,000 we put into it. So our loss potential here is 16,000 if SoFi goes to 10. And frankly, if it dropped to $10, I'd be much more inclined to buy a lot more of it than to take the loss. But so our real risk, you know, so we're selling 15 puts, which is 30,000. But realistically, if I'm going to categorize the risk on this trade, I don't see it being more than a 30% drop. And again, without us taking any action or doing anything, if we just get hit by it in one day and we wake up and it's 30% down at $10, then we would have to say, oh my God, we don't really want to own it. If something so horrible happened to this bank that, you know, there's a huge scandal or something. Something is so bad that we no longer even want to own it. Then we would take our $16,000 loss and go home. How much is $16,000? $16,000, our allocation blocks in the long-term portfolio are $100,000 each. So $16,000 barely puts a dent in an entire allocation block. So I would not even assign an allocation block to it because I consider the idea of it dropping that far to be remote. So although this trade can make $30,000 in total, it can only lose 16. It's a 2-to-1 advantage of gains versus losses. And I don't believe in the loss side. I think that's highly unlikely. So without even requiring us to take an allocation block, because it's only $16,000, we can afford the hit in the long-term portfolio. It wouldn't even phase us. So when we're setting up a trade like that, that's what makes it such a great trade, because you look at it and say, well, it's hard to imagine losing much money, yet we could make a fairly significant gain, and all the thing has to do is go from 15 back to 20. And I will remind you that their chart looks like this. We only need them to go back here in 2 years. And we make 500%. That's how you set up a trade. And meanwhile, though, again, even with all that online, when I'm getting into the trade, I'm going to offer, see the 10s? So it's 8 and 8.15, right? I'm going to offer $8 for the calls. In fact, let's do it. Okay. So this is another one we can sit there and watch it because I'm going to start tracking some of these. So single, and now usually I buy 10 and sell 10 and then buy 10 more and sell 10 more. You don't want to overdo it. But in this case, since we're just going to leave it over time, I'm not going to come back and play with it in between. I'm going to just set it for what I want. So I'm going to say I want to buy 25 longs, and I want to buy 20. Wait, make sure we're doing the right thing. So 25 SoFi 2028 $10 calls, and I'll buy them for $8. And I'll say good to cancel. And we'll send that. And now I want to sell 15 of these. 10 of these, sorry, sell. Right, sell 10 of these. And, where was it? And it was saying 430. So let's say we're going to ask for 435. That being greedy? No, I don't think so. It's down today. And now we're going to send that one. All right. So if SoFi goes down, these will fill. If it doesn't go down, we're going to get filled on the 20s. The problem is, though, I don't want to get filled on the 20s first. So I'm only going to offer to sell 10, not 20. We want to sell 20. I'm going to offer to sell 10 of the 20s, and I want a good price, $450. So if I can sell them for $450, then I've got a little more flexibility on the other side. Oh, did I do good to cancel? Ugh. I hope I didn't mess that up on the others. What is this one? Good to cancel. And go away. And that one says day trade. Knew it. Shit. So now I have to replace it just for that. Good to cancel and confirm that. Send. All right. So now I've got an offer to sell these. I've got an offer to buy these, and I've got an offer to sell those, but only 10, because ideally I want to be bullish. So if I fill 10 and it turns out to be a mistake and they bump up, I'm fine buying the longs I wanted to buy anyway, and I'll figure out how to deal with these. Because again, we want 25 of these. We don't want to sell 20 of these. We're only selling 10, but that's because just in case SoFi goes up before it goes down and I don't get my fill. But again, like I said last week, it's all about patience. And in fact, frankly, until we fill the longs, I have no interest in selling the short-term premium. So it's pieces. You have to have this, you have to have the long-term spread before you start selling short-term calls. That'd be silly otherwise. But I will sell the puts because again, I have very full confidence that this is a good trade for being bullish on. So I don't mind selling the puts for one fill. Oh, look, 115 is going to be an easy fill. It's probably going to fill right away. And we're going to say good to cancel 10 of these for 115. It's going to fill right now because it's already at that price. There you go. See? So now I have sold my July puts. And as long as they stay over 15, I'm going to make $1 for July. And 10 times is going to be $1,000. So that part of my trade is filled. So now if if we do pop and this fills, I've got $1,000 buffer against these short calls. But that's how you fill the spread. You want to make, you got to use the logic. It's like, what do I want to be? You have to keep focused on what direction do I think this is going, and what's going to happen if I only fill this or if I only fill that. What are the consequences? And you've got to be comfortable with every possible thing. It's like chess. It's like, if this happens or if that happens, and if that happens and then that happens, what's my next move and what's my next move? And this is why most people cannot handle options, because it requires a next level of thinking. Actually, frankly, it's the same reason most people can't play chess. It requires strategic thinking over multiple moves and holding that stuff in your head and figuring out all the different ways something can fail. Looking at not just how can it succeed, how can it fail? What's your position going to be if it doesn't work out? What's your fallback plan? But the most important lesson I'm trying to teach you guys, as with the UNG last week, and we're going to do this every week now, how to fill a trade. Don't accept the price your broker shows you. Don't accept these prices. You decide what you want to accept. Okay? You can't, don't get forced. Don't feel like it's so urgent to pay that you're going to not get your price. That's silly. Because here, I want to sell these for $450 because I'm bullish. And if they don't hit $450, then I'm wrong. So I don't want to sell them if they don't hit $450. And if they don't hit $450, then these guys are going to fill eventually. Because as long as it stays under $450, eventually this thing will get cheaper. Time will erode it and it will get cheaper. So if it doesn't fill, that's fine. I'm not going to sweat it. And by the way, what if this fills and it goes lower? Well, then I'll sell these guys. I'll sell the 18s instead. And maybe I'll roll down, maybe I won't. So I'm comfortable with what I have to happen. So if we fill these at 8 and it goes lower, it only costs me $1 to roll down $2 more. And then from there, it only costs me $2 to roll down $3 more. I wouldn't pay that, but I say with conviction, I wouldn't pay. I wouldn't pay 3. I wouldn't pay 2 to roll down 3. I'd pay $150. I would not pay 2. So, as a rule of thumb, if you're going to roll, you should be paying 50% of what you're rolling to for strikes. But so I know I can lower it, widen the spread, so on and so forth. But I have very good confidence in SoFi. I also have confidence in the fact that people just they don't like it. It happens all the time. They sell off for no good reason, then they come back because people see the earnings or whatever and go, "Oh, holy shit, this bank makes a lot of money." So that's what makes that a good trade. But anyway, we were talking about Warren. Getting sidetracked, right? We were talking about Warren. We were talking about the fact that he is constantly making trades. So now we go to the next day, which is Tuesday, even though it was a portfolio review day for us. And Warren said, oh, and by the way, I mean, yes, he's the ideal guy for it, but it's interesting that the round table decided that he would be the guy who picks the stocks. So it wasn't like I didn't say Warren should pick the stocks. This is a round table having discussion, and it's been very consistent that always they turn to Warren in the end and have him pick a stock, which I find very interesting. Portfolio review. Dun, 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 dun. Oh, maybe we skipped this day. Dun, dun. You're right to call bullshit on the idea that PPI is calm. We had this discussion last month. I knew I remembered it. I didn't see it. The actual report is exactly what you'd expect in headline hot, energy on fire, blah, blah, blah. See, that as I said, we thought that the PPI last month was bullshit. So it's no surprise that this month it's catching up. That's very interesting. So we had great discussion about this. Oh, so I guess we got sidetracked and we didn't do a Warren trade that day. Did we? No. This is our wrap up by this time. Oh no, 11:30. Or did it just take this long to get to it? Nope. All right. I'm going to assume this day did not have a warrant trade. Then we have the beige book, which also showed a lot of inflation. God, it doesn't seem like that long ago. It's so funny. Dun, 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 dun. Warren. Stellantis. Well, duh. Stellantis is Chrysler, basically. And let's see how they're doing. So I'm sorry. It was, let's make sure we got the price right, $845. And STLA, $759. Got cheaper. Has not performed well since what was it, April, whatever that is, 15, 17. So it's around here at 845. Oh, it's right at the top, in fact. And now it's 759. So why did Warren like it? And I don't disagree. I think they're great. I think it's an idiotic price at the moment. Immediate catalyst, Stellantis reported massive 12% year-over-year increase in Q1 shipments, moving the cars while the automakers struggle. Strategic moat, they aren't just selling cars, they're actively maneuvering. They're notoriously cheap. This is actionable. Sell out of the money, puts on STLA to manufacture a deep discount entry. If the market corrects, you get the assign. So that's, he's advocating selling the puts. It has gone badly. They had earnings, and the earnings were the EPS was good, but the GAAP EPS. So they did the write downs. They've done a ton of write downs this year. I wouldn't pay any attention to that. And the revenue misses. Yeah, they had 44.7 billion in sales versus 44.9 expected. That's certainly not something I want to hang them up to dry about. The next earnings are coming. I really like these guys. April 30th. And let's hold Warren's feet to the fire on this one, but I'll tell him to be brief. 758. Okay. STLA fell from like 850. 850. 45 to 750. 58 from your pick. Let's not over analyze. Just let's decide if it's still a play. And they better be a play because I've already put these guys out as a top trade. That's what I like about the thing. From my point of view, if Warren agrees with something I was already thinking about, I go, oh, maybe now's the time to do that. As to a cheap turnaround, prove it value trap, that distinction amount of the stock filling from is not catastrophic. Did the core balance sheet and earning power remain? I don't think it has, but management credibility is definitely weakened. What's actually happened on the thesis? Cheap valuation still true. Strong shipment growth mostly intact. Free cash flow has weakened. Global manufacturing strategy is still valid. The problem is margins deteriorated faster than expected. They are now trading ideas less like a stable cash machine and more like a cyclical industrial. But here's the important thing: 758 pricing a lot of that in already. The valuation's extreme. Okay, what went wrong? Okay, what went wrong? That's important to know. North American margins struggled. Incentives rose, pricing power weakened. Yes, North American auto sales suck. EV transition confusion, that's a big problem. Europe became a bigger risk, and of course, there's a war going on over there. So, sluggish economy, labor hegemony, Chinese. Oh, the Chinese are kicking in bass in Europe. They're not being banned over there. The balance sheet is still good. The margins matter. The brand still matters. The market is acting like the brand is structurally impaired. I don't think that's true. Management is rational about capital. You know, I'll tell you something. I don't think brands really matter in autos. First of all, you know, Hyundai, Subaru, blah blah blah. They came out of nowhere and started making cars, right? Now there's a Boyd and Rivian and things like that. People buy cars. They buy cars because the cars get good ratings and they're reasonably priced and blah blah blah. The branding of the cars, I think, is just bullshit overhead. You know, Maserati obviously has a name, but that's in the super luxury sort of thing. It's a different rationale. But for people buying a car to drive around in on a daily basis, they don't really care what it's called. It just doesn't count the way it used to count. And I think people put too much emphasis in that. They have not gone in on EVs. They've been relatively disciplined. The valuation is getting silly again, blah, blah, blah. I need to be honest about one thing. It's not the same quality setup when we thought. Shipment momentum optimism, we're lying now. Valuation's attractive, but momentum's deteriorating. Is it still actionable? Yes, but only if you treat it correctly. It's not a momentum trade. It's not a set and forget. It's back to like a cash selling thing. Would I sell puts? Yes, probably more than before because they're cheaper, because they're more expensive. Would I buy common stock here? I wouldn't. What would make me more bullish? I want to see stabilizing margins, inventory normalizations, continued buybacks, European weakness bottoming. Okay, first of all, don't have the money. This might happen. Margins, I don't think are improving. European weakness, I don't see that happening in Europe right now. Could they do a dividend cut? They already cut, so I don't think so. EV cash burn, that's kind of out. They took a huge write down for that. Credit deterioration, evidence brands are not there yet. So net. Was the thesis wrong? No. Was it early? Yes. Has sentiment collapsed too far? Maybe. Is valuation compelling? Yes. Is it riskier? Definitely. Is it still tradable? Yes. Is it high conviction back up the truck? No. So it looks like an unloved global cyclical. I agree with that. Margin stabilized, so on and so forth. Okay. So yeah, I agree. Certainly no reason to cut Stellantis, but at the moment, well, no, that's not true. At the moment, yeah, I would absolutely buy it. I would say because people are being silly. Auto industries go through slumps. That kind of stuff happens. You can sell the 2028 $7 puts for $1.40, and that will net you in for what? For $5.60. Yeah, I'll buy it for $5.60. I don't mind having, let's say, 5,000 shares for $5.60, because 5,000 shares for $5.60 would be like $25,000, $25,300 or something like that. And if it does drop down to 5, I would be very happy to double down and sell more. And we didn't talk about selling the calls. So if it drops down, like right now, it's at $7.50. I can sell the $7 calls. See, there's a lot of people betting on the upside. By the way, you can tell what the sentiment is when you look at something like that. When you look at the $7 calls, have $2 worth of premium. The $7 puts have 130. Well, I mean 130 plus the 50 cents out of the money, so you count that as $2 of premium also. Okay, so it's about the same. They both have $2 of premium at $7. But that means, though, that if you sell these puts, buy these calls and cover them, you basically have no premium in the spread. So again, you go back to that situation where if I buy 20, if I buy 50 of these for, well, I wouldn't buy those. Let me see, 7, 10. How about the 5, 4? Nope, that's not worth it. 350 minus 120. That's 230 on a $5 spread. But the 5 7s are 330 and 230, so that's $1. There you go. So if you take the 5 7 spread, and like I said, you do 50 of those, it's going to pay $5,000 if they're at 7. They're at 7 now, so it's going to pay $5,000 at 7. But you can also sell, if I'm willing to buy it, I can sell the $7 puts for $140. And if I sell 50 of those, if I'm willing to buy 5,000 shares for $7, okay, so what am I doing? If I sell 50 times 7, that's 35,000. No, that's a strike. Silly me. 50 times 140. There you go. 7,000. So I can sell 50 of those. Then I'm going to end up owning $35,000 worth if I get assigned. Earn 5,000 shares at $7. But we're going to collect $7,000. And then if I buy these spreads, it's only going to cost me $5,000 to buy 50 of the spreads because they're $1. So I'm actually going to have minus 5,000, a $2,000 credit on the $5,000 spread. So what do we make if it's over 7? We're going to make, if it's over 7, which it is now, we're going to make $7,000. And that's off. And what's our commitment? Our commitment is to own the stock we own the stock at 7, but frankly, we're getting a $2,000 credit, so we'd almost be owning the stock at 6. So that's our worst case, is owning, what do we say? 50. 5,000. No, sorry, it'd be 50 cents less. So we'd own 650. So our worst case is owning 5,000 shares for 650. That's the worst thing that can happen to us. On the upside, we get $7,000 back. So that's the trade. And it always comes down to that. What's the risk reward? What's worth doing? And the key to that then is that we are value investing. So we start out with a premise that this is too cheap, and therefore we feel pretty damn comfortable putting the money in. And again, it goes back to the familiarity of the thing. You've got to know what cheap looks like. So in other words, I live in Delray in Florida, and I know that a 2-bedroom apartment in Delray is generally around $3,500 a month. That's $3,500 would be the median price for a 2-bedroom apartment. A 1-bedroom, like 25, about 25. Let's say 25. No, really 27, 28, because you just can't get it. The extra bedroom doesn't cost much. So first of all, why would you ever buy a 1-bedroom unless you can't stand having another person living with you? Why would you not buy a 2-bedroom and have a roommate? Makes much more sense. 2 people sharing $3,500 is $1,750, or you're paying $28 by yourself. So to me, I'll be like, I'll take the roommate. But the point is, I know what an apartment is worth in Delray. I know my neighborhood. I know where people live. I know what my friends have. I know how much square footage it should have. I know everything about it. It's like knowing about a stock, right? I know everything about it. I know how far it is from the main part of town. I know where the grocery shopping is. I know what a good pool looks like. There's all these factors that are overwhelming if you don't know what it is. But if you know what you're looking for, it's easy. It's like it's obvious. That's how investing should be, right? The stocks you invest in should be that obvious. You should be able to look at it like anything that you're good at in life. You should know, right? Like if you're a doctor, you know what a healthy liver looks like. I don't know what a healthy liver looks like. I'm not a doctor. I don't know what a good heartbeat sounds like. I'm not a doctor, but I do know what a good stock looks like. I do know how much an apartment should be where I live. And I'm one of those people, by the way, who always asks. I know, but it's weird because people don't ask things like that. Whenever I walk into someone's house or an apartment or whatever, the first thing I ask is, "What are you paying for this?" Because economically, I need to know. It's like I'm just constantly. While I sit there, I like to do the math and figure out like what it's worth. It's my top concern. I'm like, oh, you have such nice sconces. Like, what are you paying for this thing? How many feet? So know that before you invite me over, because I'm going to ask. Anyway, so when you're buying anything, you should understand it. You should do some research. The AIs make it so easy to do your research and understand like what the market's like and what things should be. And I can say to Warren, briefly, he doesn't do briefly very well. Briefly, how does STL? Oh, wait, nice spelling, Phil. He wouldn't care that I misspelled it, but I wouldn't. Oh. How does STLA actually make their money? So high margin trucks and SUVs. North America is the majority of operating profit. They make money financing cars. They make money parts and service. Across the theory is they reduce cost, improve margin. So they're saying having all these different brands with the core engineering team allows them to come up with new cars and figure out things. And that's true, because it's a good idea, because they're basically saying if they're making something for Maserati and it's not good enough, they go, oh, but this would work fine on a Jeep. It's like, we came up with this really great shock absorber, but it's not quite good enough for the Maserati ride. But if we put this on a Jeep, it's going to really improve their ride. That's important. And ideas like that. Or they can make something for a Chrysler and go, this is too good for a Chrysler, let's put it in the Maserati. So so when they're doing R&D and when they're coming up with new ideas for the cars, it's basically like anything goes and you can spread it around. If you're just a Maserati dealer, everything has to be top luxury, and if it fails there, it's just a dead project. You got nothing to do with it. Automakers are cyclical. Their profits are sensitive. So they're giant global I like that. They're giant global manufacturing financing whose profits are heavily driven by high margin North American trucks and SUVs. And you guys know I like those diagrams that show you like how the money flows in and how the money flows out. I have tried getting the guys to do that. They really, it's apparently very difficult for them to do that and put it into the graphic and so on and so forth. So kudos to the guys who charge for that service. It's really good. But I'll get it eventually. We came pretty close last time I tried, and that was a few months ago. So these things keep improving. If I can do that on demand, that'd be cool, man. That'd be a really great product. So where are we? Oh, let's see if anybody has any questions before we go forward. That's this thing. Here we go. All right. Brad says, I think it was last week that a member in the chat was asking about very deep in the money bull call spread in MU. If I recall, it was 195, 300. There's roughly a 50% return with probability of 95% chance. You jokingly said we shouldn't put all that money in that. Okay. I'm not sure what that is. And I'm sorry. I lost the relevancy of that one. What is this? What the frick? Ah. Oh, okay. That was weird. Oops, I didn't mean to press enter. My question is structurally, I was looking at this and noted in hindsight, putting this trade on now, there would be a slightly better reward to risk if I chose a very tight spread or if I put on with more lots to match the risk, but I still did a 290-300 bull call spread. Now, is it a known phenomenon? Tighter spreads for such deep in the money spread will usually have a better reward to risk. You're talking about Micron? Now, it's not good for us to, you have to understand this is not really the place for individual trades. Like, it's not fair to everybody if we sit there and start taking time to do everybody's custom trades. That's what chat's for. In the chat room, ask these questions, not in the webinars. So Micron, freaking insane, up another $40 today. And so if you're asking if a 300 or a 390 400 or 290 300 spread is low risk, yeah, of course it's low risk. It's never going to, not never. It's probably never going to see these numbers again. So if you're buying spreads in here and they have good upside, then sure, it's a low risk, high reward situation. But again, it's the kind of thing that works until it doesn't. So yes, I mean, if you're looking at a 290 300 spread for a stock that's $800, then sure. Dave says, I think the tariffs are 232 tariffs that weren't reflected. See, he's as good as Warren. Dave, I will pay you $20 a month to come over here and sit next to me. Raw aluminum is 50%. Aluminum derivatives are 25%, like cans and stuff like that. Oh, this guy knows his stuff. I love that. I love people who know see, that's one of the great things about PhilStockWorld, is because in the chat room, there's all these different people who have like super expertise in things, and it's really useful. Not as useful as it used to be, because we didn't used to have AIs for all this, but and before Google, of course, it was really critical. So, back in the O's when we started, it's our 20th anniversary this year. So back in the old days, in what the hell year was that? 2005. Seems like 1985. In 2005, it wasn't. You couldn't just look shit up. It wasn't that easy. Or 2006, actually. You couldn't just Google whatever you felt like at the time. And it was so useful to have people like this. And it's still useful, so thanks, because I wouldn't even have thought to ask that question. There's the thing too, right? It's not just, when you're an expert, it's not just that he's talking about the aluminum. He's saying that, okay, aluminum is not all aluminum. What's in a can is only 25%. And raw aluminum is only 50%, and the rest is whatever materials they use to use it to create the aluminum. So that's an important consideration, saying, well, where are these things going? So Boeing plane is made out of 50% aluminum, the metal, and a tin can, though, on the other hand, is only 25% aluminum. So changes in tin cans matter less than changes in Boeing, although I imagine that the total amount of tin cans shipped are much heavier than all the Boeings. And again, these are numbers, but that's also part of the expertise. And by the way, that's a very big theory on AI I have. See, my idea, using the roundtable and such, I think that ideally each roundtable member should have a paired human. And that would make it way more effective. So in other words, if we create the same council of experts, and each expert has an AI assistant that communicates via the roundtable, then basically the assistants would be able to ask the humans what they think of things, especially when they know what your expertise is. And that's going to make it way more useful. So in other words, one AI is paired with a doctor, one is paired with a lawyer, one is paired with an engineer. So with the expertise of the humans comes into play as they read and review and look at the topics. So if we ever did turn this into like a proper large-scale consulting company, then we'd have some massive power doing something like that. And the AIs would write the reports. All we'd have to do is on the human side is just sort of like, add our expertise. So they would say, and they wouldn't bother everybody with everything, but they would say to Dave, who has a background in metals and understands engineering, and they'd say to him, we're doing a report and we're touching on your sector, and here's what we're saying. And he would just have to read what we're saying on his sector, and his import would come in. So that would be the ideal way to work it, is to have, and I don't mean just, take the 12 guys that we have now and pair them with 12 people. I'm saying those 12 bots can be paired with 100 people each using that particular one, and we'd have thousands of people who could input and so on and so forth. So that's an idea I have anyway. Marco says, can you also build this live $700 a month portfolio trade for SoFi? If you're doing it for the $700 a month portfolio, the difference is you don't have the ability to sell puts. So now you have to evaluate it differently. Now you have to say to yourself, what do I think SoFi is going to do? I think 15 is too cheap. So very simply, we take the, and again, I got to sit there and do the math. So it's 15 to 13 is $2, and it's 575 to 660. So it's less than $1. No, wait, 660. No, I'm sorry. It is more than $1 to roll down. I would not pay more than $1 to roll down. The 15s to the 18s is only about $1. I would absolutely pay $1 to go from the 18s to the 15s. I would not pay the other way. So we're going to buy the 15s. We're going to sell. I want to keep the cost down. All right, sell the 20s. So again, let's say we 25 times on the 8 on the, I'm sorry, we said the 18s or the 15s. 485, 585. Okay, no, 15s. So we're going to take the 15s for 575. So 25 times 575, $14,000. Then I would do 20. Yeah, okay. So then 20 of the 20s, and those are 425. So that's going to be $8,500 for 20. So minus 8,500. So that's our longs at 58.75 on the $25,000 spread, right? Nope, sorry. It's 25 on the $12,500 spread. So it's a $12,500 spread. No, wait, 15 to 20. So 25 of these is a $12,500 spread. You're in it for $5,800, so you have 100% upside potential there. And we sell, and again, we don't have margin, so we can only sell 5 of the $16 calls, and that's 122. Well, let's say 125. And that's going to be $725. So minus 725 means our net cost is $5,150. It's a $12,500 spread, so there's about $7,000 of upside potential there. And what do we sell here? And it'd be 125 times 5 is 625 times 6 more of those is 3750. So there's another 3750 in option selling. So we could make, so on the $5,000 outlay, we can get back $10,000. So that's a 200% upside using no margin. No margin, 200% in 20 months, 10% a month. So that's good. For a no margin, small money portfolio, that is absolutely the way to do it. By the way, it would actually be better from a return standpoint if you did 15 longs and 10 shorts, because you still have the same 5 available to sell. You'd be spending a lot less money, maybe 3,000 something for the spread, and then you'd have If you had 15 longs times 5, you'd have a $7,500 return. So let's say you knock the spending down to $3,500 or less, you're going to get $7,500 back, but you're going to get the same $3,750 here. See, so you're going to get a lot better upside with less cash outlay. So if you have a small portfolio and you don't want to over allocate to this position, that's how you do it. And that's the sweet spot for the $700 a month portfolio. Our sweet spot is things under $20. It gives you room to maneuver and make clever trades like this. When you get into higher value trades, not higher value, higher price trades, because it doesn't mean value. It has nothing to do with it. If it's a higher price trade, you can only buy a few. You have to be very careful. It can blow you out, that kind of stuff. So you got to be a lot more careful. And don't forget, there's nothing to the upside that can hurt us. All it can do is limit our upside, because we own the $15 calls, right? We sold the $20 calls on the long side. These are $1.25. The 2028 $20 calls are $4. So there's no possible scenario unless you fall asleep, unless it's Micron, unless you get Micron. That should be a new term. Unless you get Micron and your stock goes up 100% in 3 sessions or something like that, that's when you can run into trouble. But and I'm sorry, still not trouble, because you still own the $10 calls. You sold the $7 calls. So instead, on 5 contracts, instead of getting the $5 spread you expected, you only have a $2 spread on 5 contracts. It's not losing. You're still making money. You're just not making as much as you expected to. But again, you'd have to be completely asleep at the wheel. You'd have to let this happen to you without making any changes. And again, it's not that likely that SoFi Bank is going to suddenly wake up and go, "Oh my God, look at the amount of sales we have all of a sudden." Banks don't work that way. So it could happen, but it probably won't. So it technically can't hurt you. You are covered on those 5 short calls that you're selling in July. They are easily rollable, and so it's just money. It's all it is money that comes in and drops in your pocket. Every 2-3 months, you're dropping $1,000 into your pocket off a $5,000 net outlay. That's why I love it. You're getting 20% back, cash in your pocket every couple of months. That's phenomenal. It's like, why would you not make that trade? And especially, it's not freaking Micron. It's not like, Micron could easily go back to 500, 600 like that very quickly, as quickly as it went up. But SoFi, and this is weekly, SoFi hasn't been below 50. Well, we had that trade thing. That was what that is. So realistically, SoFi did pop from 7 to 15. So these guys got burned, right? Popped from 7 to 15. Then it went from 15 to 30. And then it went all the way back down to 15. If it consolidates here, you're going to be golden. It's probably going to go back to 30 now. Based on the numbers, there's no reason it should be trading this much. It shouldn't have been trading at 34. That's silly. But it's quickly growing into its valuation. So as long as their earnings don't suck, and they just had them. So they beat, a small beat, but they beat here and they beat here. They're in line. They weren't great, and they gave conservative guidance. That's why they've been floundering around. But if we think 15 is a solid floor for these guys, then why not? That's a low risk way to make $200. I mean, 200%. Now, Argus says hold. Wells Fargo says 19. Citizen said 30. JP Morgan, they seem to know what they're talking about. They said 31. Needham said 36. They're keeping it this year. B of A said 20 at the time. All right. So did things really deteriorate between those calls and now? No, not really. We'll see what earnings are next quarter, but I mean, I seriously think they'll hold. And I think when they if they give a better report, a little bit more upbeat guidance, they'll start moving right back over 20. And you're locked in. That's 20 is our target. We're not targeting 30. We're saying in 2 years it'll get back to 20. They would have to be very, very disappointing for the next 2 years to stay at 15. I mean, look at the sales growth. They're definitely increasing their sales. They're definitely turning the corner and they're moving into profitability. And it's only 20 times earnings with this kind of growth path. With that kind of growth path, you have to understand it costs money to make money. They have to open up branches or they have to expand their online presence. They have to build better systems and computers and so on and so forth and do some advertising. All that stuff costs money and it comes back over time as their customers increase and they have more and more revenues coming in. At some point, they will slow down the spending and start reaping the rewards. That's how businesses work. So over the next couple of years, I expect them to get back into a form that justifies all these $30 valuations that they were getting. So Argus, interestingly, on April 15th, when's April 15th? Interesting. See, that's why you got to check that too. On April 15th, Argus said hold, and that was 18, 19 bucks. So that was 19 bucks when Argus said hold. Nobody listened to them. It went down. But that's what Argus is target. So even though when it says hold means hold. So it didn't have a target, but it's there. And Wells Fargo before them also said 19. So there's no price here, but these are both 19s. So these guys feel it's too cheap at 15. They're picking 19. That's this year target is 19. We care about the next year target. That's the end of the year. Next year is the target we care about. Ooh, wow. Questions are pouring in. Larry says, we have June 2028 for SoFi. Why have we not used them instead of January? I'm sorry for the purpose of the question I was just asked. I mean, it doesn't matter. They're interchangeable. If I'm evaluating that, what you want to do is I didn't see it on the chart when I was looking. Here's June. Okay, so if I'm looking at the January 10s, they're $8. How much are these 10s? They're $8. So for for what? For 50, not even 50 cents. So for 40 cents, would I buy another 6 months? Of course I would. That's it. That's your decision tree. And if you want to calculate it, how many months is this? This is 618 divided by 30, which is, I can tell you right now, it's 21. so it's 21 months. And this is going to be, this one I need to calculate, 765 divided by 20 is 38 months. What? 765 divided by 30, 25 months. Thank you. So this is 25.5 months. This is 21 months. So for 4.5 months, should I spend 40 cents? Well, the question is, at what rate of theta decay are we at? Well, if it's 8 divided by 21, so it's 8 divided by 21 months, theta decay is 40 cents a month. So therefore, bargain. I'm buying 4 months for 40 cents. Therefore, I'm lowering my theta decay significantly. That's the answer to that question. Do the math. But certainly not important. not important for like setting up a trade. Oh, now Steve, boy, everybody's in here today. Not sure if anyone's mentioned the 700. Hewlett Packard shows 15 July, 20 seconds. They should be 0.5 GEO and NVO are not updated, and SQQU covered all the short calls. Ay. If I missed anything, please put it in writing and let me know in chat. This is absolutely not the place. This chat disappears when I close the webinar. So if there's anything missing in the review, let me know. Let's fix it. Okay. I appreciate that you find it, but you need to tell us in chat. Marcos. So $25, $15 calls, $20, $20 calls. What's the short-term call? Marcos, in chat. Okay, I'm not doing this anymore. I'm not going back and forth and customizing trades and then getting into the nitty-gritty of every piece of it that you didn't get the first time. That's why you don't ask those questions in the freaking webinar. That's what the chat room is for. We put it in writing, and it's easy to sit there and look at it and make sure we get everything right, not to go back and forth in the chat box. Can you please on defense stocks? Can you please on defense stocks? They've been hit hard lately. And again, in the chat room, that's what the chat room is for. I'm very, very happy to have the bots run these things for you in the chat room. I'm not going to be running it. We have 12 minutes left for this webinar. And you're asking about 1, 2, 3. You're asking about 4. You're asking about 4 different defense stocks. You want me to analyze them and give you a custom information on it. It's like, that's what the chat room is for. And Brad is saying, with SoFi, do you worry at all about the income share dilution? No, because they're getting money. This is how they need to grow their account base, and therefore they need to bring in money from somewhere. So they're either going to borrow it from another banker or something like that, or they're going to sell shares. As the shares become more valuable, they convert it into cash, and then they take the cash and they lend it out and they get more earnings. It's like that banking scene in It's a Wonderful Life with Jimmy Stewart. So there's a scene in the bank and there's a run on the bank. This is in the Depression, so there's a run on all the banks. And the people come crowding into the banks because they heard his bank might be going under. And so they all want their money back. And we're hearing this now with private equity, right? It's the same thing. The private equities are invoking. There's always a thing in a private equity contract that says you can only withdraw 5% of your money per month or per quarter or something like that, because it's not realistic. Because the whole point of the bank is they take your money, your actual money, and they lend it to people and businesses. And they lend $50,000 to this guy for his deposit on a house. They lend a $250,000 business loan, whatever. If you want your money back, they don't have the recourse to suddenly turn around to the people they lent money to and say, "Oh, sorry, my backseat, let's go." It's not how a bank works. So banks have to bring in capital. If there is a large appetite for their products, for loans, and they're not getting capital in fast enough. So in other words, there are more people asking for loans than there are people giving them deposits, put it that way. And that's because they are gearing towards a younger crowd, but the younger crowd is asking them for student loans and things like that are substantial amounts of money. So their customers are opening accounts and they are taking out larger loans than have anything to do with their accounts. So they constantly got to go outside and seek some capital. But what are they doing with the capital? They're not spending it. They're not building, rockets to frickin' Mars and whatever, like Elon Musk. They are taking the money and putting it into productive loans. And those loans pay back over time. And when more money comes in, they take it and lend it out and make more loans. That's how every bank grows. Hopefully, some banks will grow based on their deposit base and so on and so forth, but SoFi is very small comparatively, and they've got to just constantly be in raising money. So what they do is they have certain hurdles that they hit. And by the way, you should be thrilled that they did this, because in 2025, they sold 170 million shares. Okay? So in 2025, they sold 170 million shares. Hopefully not down here. But if they sold them at 15, that's how they funded this growth. And I imagine that you'll find that they've sold more shares in 2026, that their share count should be higher now. Well, we can ask that. See, it's all a question of you know what to answer. How many shares has SoFi sold this year, and at what price? What raise? If he can find it, he'll tell us. Nope. Common stock 1.5 billion at 27. Oh, there you go. So in December, they sold 1.5 billion at 27 blah 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 per share. So that's going to be, make sure the math works out, 25, no, $15 billion. No, we got to do it. 15 billion divided by 28, let's say, 500,000 shares. Well, I'm thrilled. And that's exactly what I'm saying, though. They get to a point and they say, Jesus Christ, $27.80 a share. Let's sell. Where is that? As they should, right? That's what I want. Oh, yeah, right. Great job, man. So they sold here. They diluted themselves by 10%, more than 10%, let's say 15%. They diluted themselves by 15%. And then the stock drops because their earnings per share goes down. And most traders only look at the EPS went down or the EPS was disappointing. I look at they raised $1.5 billion and they only just started lending it out. They've only had it for 3 months, 4 months. So they've only had the money for 4 months. They're engaging with new customers and lending the money out, and that will eventually drop another $150 million a year to the bottom line. And SoFi only makes 800 something million. So it's a significant increase in their annual revenues. In their annual profits, if they're dropping 10% to the bottom line. I don't know what they're dropping to the bottom line, but so that's what a bank does. And so you say to me, am I upset that they diluted the shareholders by 15% to get $1.5 billion, which is, by the way, more than they should have gotten for 500 million shares? They've got how many shares outstanding? Ugh. Why is it so hard to find things out? Shares outstanding. There you go. They have 1.2 billion shares outstanding. So they sold 500 million shares. So they diluted their shares by there were 750. There were 750 million shares. They diluted by, well, 500 divided by 750. Is that right? Did we say they sold 500? No, they sold 500,000 shares. Silly me. They sold an insignificant amount of shares in that case. I'm sorry. They sold an insignificant amount of shares. 500,000 shares is what they sold. They collected 1.5 billion. So they sold an insignificant amount of shares dilution-wise. They raised 1.5 billion, which is 15% of their market cap. That's the key. Or I'm sorry, 7.5%. So they sold 7.5% of their market cap for 5% of their shares, or less than 5% of their shares. That's a good ratio. That's what I want them to do. That was a smart thing to do. The stock went up from 20, forget the dip, but the stock went from 20 to 30, it went up 50%. How stupid would it be not to cash in? If people are willing to pay that for your stock, they know it's not worth that. They're not delusional. They've said, oh, let's sell some shares if people want to pay that kind of money for the stock. And you know what they'll probably do? If it goes much below 15, they'll start buying it back. So no, they're doing what a bank should do. They're running it like a business, and they're being, very opportunistic about what they're doing, which is fantastic. Oh, and Brad says 15. No, it's a whatever the calculation is. It was 1.5 billion, but it's 500,000 shares. That's the key. So anyway, did we get to anything today? No. Oh my God! I didn't even talk about PPI. PPI horrific, by the way. Absolutely read our write up in the chat room. It's an epically bad PPI number. I don't understand how the markets are holding up. I don't know what they're doing right this minute, but I don't think they're. But as far as I know, they're still holding up. What? Oh, those are loans. I was just looking. The 30-year fixed is now. Look at the Dow. It's only down 75 points. So 30-year loans is still 6.5%. Speaking of lending, the S&P is up 50 points, 74.50. The PPI number is, the Nasdaq's up 1.3%, 337. I mean, this market is nonstop, and that was the point of the article today, which let's just briefly touch on that. Boy, there's so much to talk about. We could do this forever, right? It's like so many things. Can't believe that was 2 hours. It was a good conversation. So today, markets get knocked down, but they get up again. That's exactly what we're seeing today. You've got these 7 stocks that are bigger than the entire UK market. This is 1/3 or 40% of our total market is these stocks, is the top 10 anyway. And what's happening is because it's a self-reinforcing system, because as these stocks get more money, they have a bigger share of the S&P and a bigger share of the Nasdaq. The biggest shares of the S&P and the Nasdaq means that all the money that, when you have your 401k or your IRA, you're generally restricted to ETFs. So you pick, I'm going to put this much into a tech ETF. I'm going to put this much into the S&P 500 ETF. So SPY and QQQ. The money that goes into SPY and QQQ is distributed according to the market caps of the components. So when you put your money into the SPY or QQQ at work, 70% of your money or 40% of your money is going to the Magnificent Seven. That's how it works. And it is in the Nasdaq. They're 2/3 of the Nasdaq, because these are all Nasdaq companies. The Nasdaq's a way smaller index. The S&P is the big one, and the S&P is 50-something billion. The Nasdaq is these companies. The other companies in the Nasdaq don't mean shit compared to these companies. The S&P is the one with the top 500 companies. So it's a real distortion, and the bigger they get, the more money they take, because the next day it's re-indexed, and the money goes proportionally more to them. And at the same time, the non-top 10, the 490 lower stocks of the S&P, they get smaller, so their share drops. So the Magnificent Seven are 35%, and the rest of the stocks are 65%. Then the top 10 stocks are 40%, and the other stocks are 60%. So it goes at the same time. Both things are happening. The other companies are getting fed less money. The top companies are getting fed more money, and that's just going to keep happening and keep happening. And the money gets squeezed, and more money is chasing the same amount of shares. So you get this kind of rapid rise in the top stocks. But that's what it's all about. So that's the main reason that's happening. Then you've got the buybacks, and the top, and again, the top, there's $2 trillion being spent on buybacks and dividends this year. And that's obviously not the smaller companies. It's all these big giant companies are buying back their own stock at the same time. They're like, if you don't want it, we want it. That's basically the attitude. I had numbers or something. Oh yeah, number 2. So number 2 is, and also, and this affects all the companies, but also, to a large extent, Apple's getting a huge amount of money and so on and so forth. $160 billion is being fed back from the tariff money that was already paid out, is now getting refunded to all these companies. S&P quarterly earnings are roughly $500 billion. So they make about $2 trillion a year. And by the way, when you say they make $2 trillion a year, that's after their write-offs and their tax deductions and all the other things they put in, then their accelerated depreciation, blah, blah, blah. They make way, way more money than $2 trillion, but $2 trillion is what they claim. And by the way, if the S&P 500 is $56 trillion and they make $2 trillion, then they're trading at 28 times earnings. If they make $56 trillion and they make if they're valued at $56 trillion and they make $2 trillion, then they're trading at 28 times earnings. That's the fact. So, everybody's got these different numbers and games. Now, Case-Shiller takes their CAPE ratio. They look at the last 10 years trailing. You look at that, and that's the way to look at the indexes anyway. It's not what they earn now, but what they've been earning, and it gives you an idea. And so it smooths out this blip sort of money that's coming in right now. And if you take away the blip money, the S&P is trading at 40 times earnings. We're hitting a critical level of 40 times earnings on the S&P 500. If you adjust out, if you say over the last 5 years, or over the last 10 years, not over the last, not projecting forward your best case scenario. But anyway, so it's $2 trillion a year, it's $500 billion a quarter, and you're getting a refund of $160 billion in one quarter. Refunds are going out now. It's going to hit their Q2 earnings. It's going to look like they made a fortune because of the tariff inflows. And so the guidance for Q3 is much higher. And that's why you're seeing these numbers, like they're saying 27% more earnings than last year. Yeah, because you're the money you already booked as expenses last year, the tariffs and shit, you're getting it all back. It makes it look better, but you know what's going to happen after that? After that, there's going to be a tremendous fall off, especially if Trump does reinstate some tariffs. But right now, there's no, and that's the other thing, the tariffs that they expected to have aren't hitting them. So there's no 10% tariffs that they expected, and they're getting the money back from the other tariffs. So massive gains. And that means, of course, that this party that's happening, it can keep going on until next quarter, when the companies are going to have to say, well, you know what, we already got the tariff money back, and now Trump figured out how to give us a new tax, and therefore we're going to make way less money next quarter. As soon as you start hearing that, and that's going to happen, it'll happen sooner than earnings in August. It'll happen when the early companies start reporting in July. But as soon as the early companies start reporting in July, this story is going to start spreading, and everybody's going to say, oh my God, this is a disaster. I'm telling you now. And the funny thing about that is it's so freaking obvious. It's absolutely what's going to happen. We know this now. It's May. We know what's going to happen in July. But yet people are still just buying stocks as if nothing's wrong. Buybacks, I said the buybacks. And of course you've got the CapEx. That's real. These companies, not this guy, not Ellison, but these guys have the money. Ellison is doing a Field of Dreams thing. It's like, if you build it, they will come. Ellison is building all this infrastructure because OpenAI promised they're going to give them some money, which they may or may not end up having. And he's building all this stuff based on promises and expectations. He's dreaming. If it doesn't fall through, he spent all this money for no reason. So this is very dangerous speculation. Amazon also a bit ahead, but Amazon is feeling the pressure because they don't have. He's got a bot. He's got a bot. He's got a bot, even though his bot sucks. So I wouldn't even say he has a bot. Meta does not have a bot, but Microsoft has a bot. Google's got a bot. OpenAI's got a bot. Anthropic's got a bot. There's a lot of bots. Bezos doesn't have one. That's a problem. He does have Alexa, but it's nowhere as good as an AI. But he is spending the money and he's trying to catch up. Ellison, forget it. He's building massive infrastructure. Maybe for good reason. Maybe it's a good gamble. Maybe it'll pay off. But if it doesn't pay off, he's risking his whole company. I think that's not smart. Anyway, that's mostly what we talked about here. But then we had very extensive PPI conversations in chat. I might make that into a post later because it was so good that it should be read by millions of people. And that's it, guys. Thank you, everybody, for coming. And we will do this again next week. How do I shut this off? I always get this wrong. Dun, 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 dun. Yeah, that's it.